Question 1. Performance analysis shows that a surplus lines insurer has issued a policy to a manufacturing company that utilizes a new chemical process with potential, but not yet fully understood, environmental byproducts. The policy does not contain specific exclusions or endorsements related to these byproducts. The insurer is now aware of emerging scientific research suggesting these byproducts could pose a long-term environmental risk. What is the most appropriate course of action for the surplus lines insurer? Option A. Rely on the insured's assurances that their operations are compliant with all environmental regulations and that no additional policy provisions are necessary. Option B. Advise the insured that the policy does not cover environmental liabilities and that they are solely responsible for any future claims arising from the chemical process. Option C. Immediately review the policy wording and engage with the insured to understand their environmental management practices and the potential risks associated with the new chemical process, considering the need for endorsements or exclusions to address identified exposures. Option D. Assume that since environmental risks were not explicitly excluded, the policy will cover any resulting claims and continue to monitor the situation without further action. The correct answer is C. Immediately review the policy wording and engage with the insured to understand their environmental management practices and the potential risks associated with the new chemical process, considering the need for endorsements or exclusions to address identified exposures. Explanation. This scenario is professionally challenging because it requires a surplus lines insurer to navigate complex and evolving environmental regulations that may not be explicitly covered by their existing policy wordings or underwriting guidelines. The insurer must balance the need to provide coverage for emerging risks with the imperative to comply with all applicable laws and avoid potential regulatory penalties or reputational damage. Careful judgment is required to assess the adequacy of current underwriting practices and to implement appropriate risk management strategies. The correct approach involves proactively identifying potential environmental liabilities associated with the insured's operations, even if not explicitly stated in the policy. This includes conducting thorough due diligence, engaging with the insured to understand their environmental practices, and potentially requiring specific endorsements or exclusions to address known or foreseeable environmental exposures. This approach is justified by the regulatory framework governing surplus lines operations, which generally requires insurers to act with due diligence and to ensure that their policies do not contravene public policy or statutory requirements. Furthermore, ethical considerations dictate that insurers should not knowingly provide coverage for activities that pose significant environmental risks without appropriate safeguards or disclosures. An incorrect approach would be to assume that because environmental liabilities are not explicitly mentioned in the policy, the insurer has no responsibility. This fails to acknowledge the broader regulatory and ethical obligations of an insurer to understand and manage the risks it underwrites. It also ignores the potential for claims arising from environmental damage, which could lead to significant financial losses and regulatory scrutiny. Another incorrect approach would be to simply deny coverage for any environmental-related claims, regardless of the policy's terms or the insured's actions. This demonstrates a lack of understanding of the insurer's obligations and could lead to disputes and legal challenges. It also fails to consider the possibility of latent environmental conditions that may not be immediately apparent, but could give rise to claims under the policy. A third incorrect approach would be to rely solely on the insured's representations regarding their environmental compliance without independent verification. While insureds have a duty to disclose material facts, insurers also have a responsibility to conduct their own due diligence to assess the risks they are undertaking. Over-reliance on the insured's statements without independent verification can lead to underestimation of environmental risks and potential coverage gaps. The professional decision-making process for similar situations should involve a systematic risk assessment that includes identifying potential environmental exposures, evaluating the adequacy of existing policy language, consulting with legal and environmental experts when necessary, and implementing appropriate risk mitigation strategies. This proactive and diligent approach ensures compliance with regulations, protects the insurer from unforeseen liabilities, and upholds ethical standards in the insurance industry. Question 2. Implementation of a new cyber insurance policy for a large technology firm reveals that while several admitted market insurers offer cyber coverage, their policy terms are restrictive, and the premiums are significantly higher than quotes received from non-admitted insurers. The firm's broker believes the non-admitted insurers can offer more tailored coverage and competitive pricing. It suggests proceeding with a surplus lines placement without further attempts to secure coverage from admitted carriers. What is the most appropriate course of action for the broker? Option A. Immediately inform the client that the firm is ineligible for surplus lines coverage due to its size and the nature of its business, and direct them back to the admitted market. Option B. Advise the client that surplus lines insurance is generally more expensive and less regulated, and recommend they accept the terms offered by the admitted market insurers. Option C. Proceed with the surplus lines placement, as the non-admitted insurers offer more tailored coverage and competitive pricing, which meets the client's immediate needs. Option D. Conduct a thorough and documented investigation into the availability of comparable coverage from admitted market insurers, and only pursue surplus lines if admitted market capacity is demonstrably insufficient or unavailable for the specific risk. Correct answer is C. Proceed with the surplus lines placement, as the non-admitted insurers offer more tailored coverage and competitive pricing, which meets the client's immediate needs. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the surplus lines market's purpose and regulatory boundaries. The core challenge lies in distinguishing between legitimate surplus lines placements, which address risks uninsurable in the admitted market, and attempts to circumvent admitted market regulations for convenience or cost savings. Careful judgment is required to ensure compliance with the spirit and letter of surplus lines laws, which are designed to protect policyholders while allowing for specialized insurance solutions. The correct approach involves a thorough assessment of the risk and the availability of coverage in the admitted market. If a diligent effort to secure coverage from admitted insurers has been made and failed, and the risk is indeed unique or difficult to underwrite, then placing the coverage with a non-admitted insurer through surplus lines channels is appropriate. This aligns with the fundamental principle of surplus lines insurance, to provide coverage for risks that admitted insurers are unwilling or unable to insure. Regulatory justification stems from statutes that permit surplus lines transactions only when admitted market capacity is insufficient. Ethically, this approach upholds the policyholder's need for coverage while adhering to the regulatory framework designed for market stability and consumer protection. An incorrect approach of immediately seeking surplus lines coverage without first exhausting admitted market options is a significant regulatory failure. This circumvents the primary purpose of the admitted market and the regulatory oversight it provides. It can lead to policyholders being placed in non-admitted policies without a clear understanding of the differences in consumer protections and solvency assurances. Ethically, this is a breach of trust and a failure to act in the client's best interest by not exploring all available and regulated options first. Another incorrect approach of placing coverage with a non-admitted insurer simply because it offers a lower premium, even though admitted market coverage is available, is also a regulatory and ethical failure. Surplus lines are not intended to be a price shopping mechanism to bypass admitted market regulations and consumer protections. This action undermines the regulatory structure designed to ensure fair pricing and adequate consumer safeguards within the admitted market. It prioritizes cost over compliance and potentially exposes the policyholder to risks associated with less regulated entities. The professional decision-making process for similar situations should begin with a clear understanding of the client's risk profile and the specific insurance needs. The first step must always be to diligently investigate the availability of coverage within the admitted market. This involves contacting multiple admitted carriers and documenting the efforts made. Only if coverage cannot be obtained from admitted insurers and the risk genuinely falls outside their underwriting appetite or capacity should the surplus lines market be considered. A thorough understanding of the non-admitted insurer's financial stability and reputation is also paramount. This structured approach ensures compliance, protects the policyholder, and upholds the integrity of the insurance market. Question 3. Which approach would be most appropriate for a surplus lines broker when a client in a rapidly evolving technology sector requests professional liability insurance, errors and omissions, coverage, and the broker suspects the standard admitted market may not fully address the client's unique and emerging risks. Option A. Conduct extensive due diligence on the client's operations and specific technological exposures. Research specialist surplus lines insurers with expertise in technology E&O, and present tailored coverage options with clear explanations of terms and limitations. Option B. Accept the client's stated coverage needs at face value and offer a readily available, generic E&O policy from an admitted insurer, assuming it will suffice. Option C. Immediately seek quotes from any available surplus lines insurer without verifying their eligibility or underwriting expertise in the technology sector. Option D. Advise the client that E&O coverage is not feasible for their industry and decline to pursue the placement. The correct answer is A. Conduct extensive due diligence on the client's operations and specific technological exposures. Research specialist surplus lines insurers with expertise in technology E&O, and present tailored coverage options with clear explanations of terms and limitations. Explanation. This scenario presents a professional challenge because a surplus lines broker is tasked with securing professional liability insurance errors and omissions for a client operating in a niche, high-risk industry. The challenge lies in accurately assessing the client's unique exposures, understanding the limitations of the surplus lines market for such specialized coverage, and ensuring the client receives appropriate protection without misrepresenting the risks or the available solutions. Careful judgment is required to balance the client's needs with the realities of the insurance market and regulatory compliance. The correct approach involves conducting a thorough due diligence process to understand the client's operations, potential liabilities, and claims history. This includes engaging in detailed discussions with the client to gather comprehensive information, researching the specific exposures inherent in their industry, and then approaching specialist surplus lines insurers who have expertise in underwriting such risks. This approach is correct because it prioritizes accurate risk assessment and informed placement, aligning with the surplus lines broker's duty to act with diligence and skill. It also adheres to regulatory requirements that mandate brokers to make diligent efforts to place coverage with authorized insurers, or, when using surplus lines, to ensure the coverage is appropriate for the insured's needs, and that the surplus lines insurer is eligible to write the business. Ethical considerations also dictate that the broker must act in the client's best interest, which necessitates a deep understanding of the risk to secure adequate coverage. An incorrect approach would be to simply accept the client's self-assessment of their E&O needs without independent verification. This is professionally unacceptable because it fails to meet the broker's duty of care and diligence. The client may underestimate their exposures, leading to inadequate coverage. This could result in regulatory scrutiny for failing to adequately assess risk and place appropriate coverage. Another incorrect approach would be to immediately offer a standard E&O policy without considering the client's specific industry or seeking out specialist markets. This demonstrates a lack of understanding of the surplus lines market's role in providing coverage for unique or hard-to-place risks. It could lead to the client being offered a policy that does not adequately address their specific exposures, potentially leaving them uninsured for significant liabilities. This also risks violating the principle of placing coverage with insurers best suited to underwrite the risk. A third incorrect approach would be to recommend a policy from an unauthorized surplus lines insurer without confirming their eligibility and financial solvency, or without properly documenting the diligent effort to place the coverage with an authorized insurer first. This directly contravenes regulations governing surplus lines operations, which typically require that coverage be placed with eligible non-admitted insurers only after a diligent effort has been made to obtain it from authorized insurers. Failure to do so can result in significant penalties for both the broker and the insured. The professional reasoning process for similar situations should involve a structured approach. First, thoroughly understand the client's business and their specific liability exposures. Second, research the market for available E&O coverage, identifying both admitted and surplus lines options. Third, engage with specialist surplus lines markets if admitted markets are insufficient or unavailable, ensuring the chosen insurer is eligible and financially sound. Fourth, clearly communicate the terms, conditions, limitations, and exclusions of any proposed coverage to the client. Finally, maintain comprehensive documentation of all efforts communications, and decisions made throughout the placement process. Question 4. The analysis reveals that a broker is attempting to place a unique, high-value cyber risk that has been declined by several admitted insurers due to its complexity and potential for catastrophic loss. The broker believes that surplus lines insurance is the most efficient way to secure coverage for this client, even if it means bypassing some of the standard market's underwriting requirements. Which of the following best describes the fundamental purpose of surplus lines insurance in this context? Option A. To provide a less regulated and more cost-effective alternative for all types of insurance risks, regardless of their placement in the standard market. Option B. To allow insurers to avoid paying state premium taxes by offering policies outside the traditional regulatory framework. Option C. To provide a market for risks that are simply too small or insignificant for admitted insurers to underwrite profitably. Option D. To offer coverage for risks that are uninsurable in the admitted market due to their unique, unusual, or hazardous nature, after diligent efforts to place them through admitted insurers have been unsuccessful. The correct answer is A. To provide a less regulated and more cost-effective alternative for all types of insurance risks, regardless of their placement in the standard market. Explanation. The analysis reveals a common challenge in surplus lines operations, distinguishing between standard market insurance and the unique purpose of surplus lines. This scenario is professionally challenging because it requires a deep understanding of regulatory intent and market functionality, not just a superficial definition. Misinterpreting the purpose of surplus lines can lead to regulatory noncompliance, market disruption, and potential financial harm to policyholders and insurers. Careful judgment is required to ensure that surplus lines are used appropriately as a last resort for risks that cannot be placed in the admitted market, rather than as a means to circumvent standard market requirements or offer substandard coverage. The correct approach involves recognizing that surplus lines insurance exists to provide coverage for risks that are unique, unusual, or difficult to place in the admitted market. This means the primary purpose is to fill a gap in the standard insurance market, not to compete with it or avoid its regulations. Regulatory frameworks, such as those governing surplus lines operations, are designed to ensure that policyholders have access to necessary coverage while maintaining solvency and consumer protection. Therefore, understanding that surplus lines are a specialized market for non-standard risks is fundamental to compliant operations. An incorrect approach would be to view surplus lines as simply a less regulated market where any risk can be placed. This fails to acknowledge the surplus aspect that the risk must first be declined by a specified number of admitted insurers. This approach ignores the regulatory requirement to exhaust the standard market, which is a cornerstone of surplus lines regulation designed to protect consumers and maintain the integrity of the admitted market. Another incorrect approach is to consider surplus lines as a mechanism to offer coverage that is intentionally inferior to admitted market policies. This misunderstands the purpose, which is to provide coverage for risks that are uninsurable in the standard market due to their nature, not to offer cheaper, less robust alternatives. Such a view would likely lead to offering policies that do not meet consumer needs or regulatory standards for financial protection. Professionals should employ a decision-making framework that begins with a thorough understanding of the risk presented. They must then assess whether this risk has been genuinely explored and declined by the admitted market. If the risk is indeed uninsurable in the standard market due to its unique characteristics, then surplus lines becomes an appropriate avenue. This process requires diligence, adherence to specific declination requirements, and a commitment to finding coverage that, while potentially different in structure or terms, still adequately protects the insured for the unique risk. Question 5. Risk assessment procedures indicate a commercial property with a unique, high-hazard manufacturing process that has historically experienced significant claims. The insured is seeking coverage and has expressed concern that admitted insurers will be unwilling to offer terms. Which of the following approaches best distinguishes this risk as a potential candidate for surplus lines insurance, adhering to regulatory requirements? Option A. Accepting the insured's verbal assurance that admitted insurers have previously declined coverage for similar operations, and then seeking a surplus lines quote. Option B. Documenting a diligent effort to obtain quotes and formal declinations from multiple admitted insurers, demonstrating that the admitted market, despite its capacity, is unwilling or unable to provide coverage for this specific risk due to its unique characteristics and claims experience. Option C. Obtaining a single declination from a well-known admitted insurer that indicates a reluctance to underwrite such specialized risks, and then placing the coverage in the surplus lines market. Option D. Immediately proceeding with a surplus lines placement due to the high-hazard nature and past claims history, as these factors typically preclude coverage in the admitted market. The correct answer is D. Immediately proceeding with a surplus lines placement due to the high-hazard nature and past claims history, as these factors typically preclude coverage in the admitted market. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the fundamental differences between admitted and surplus lines insurance markets, specifically concerning the availability of coverage in the admitted market. Professional must accurately assess whether a risk truly falls outside the scope of what admitted insurers are willing or able to underwrite, which is the cornerstone of surplus lines eligibility. Misinterpreting this can lead to regulatory noncompliance and potential financial harm to the insured. The correct approach involves a thorough investigation into the admitted market's capacity and willingness to cover the specific risk. This means actively seeking quotes and declinations from admitted insurers, documenting these efforts, and demonstrating that the risk cannot be placed through the standard market due to its unique nature, high hazard, or insufficient capacity. This aligns with the core principle of surplus lines insurance, which is to provide coverage for risks that are not readily available from admitted insurers. Regulatory frameworks, such as those governing surplus lines operation, mandate this diligent effort to exhaust the admitted market before resorting to the surplus lines market. This ensures that the surplus lines market serves its intended purpose as a secondary market for unique or difficult-to-place risks, rather than a primary market for all risks. An incorrect approach would be to assume that because a risk is complex or unusual, it automatically qualifies for surplus lines. This fails to acknowledge the obligation to first explore admitted market options. Another incorrect approach is to rely solely on the insured's assertion that the risk is uninsurable in the admitted market without independent verification. This bypasses the due diligence required by regulators. Furthermore, accepting a surplus lines placement simply because it is more convenient or offers a slightly better premium without demonstrating a genuine lack of admitted market capacity is a failure to adhere to the spirit and letter of surplus lines regulations. Professionals should employ a decision-making framework that prioritizes regulatory compliance and client best interests. This involves 1. Understanding the specific regulatory definition of eligible surplus lines risk within the relevant jurisdiction. 2. Conducting and documenting a comprehensive search for coverage in the admitted market, including obtaining formal declinations. 3. Evaluating the reasons for any admitted market declinations to confirm they are based on the risk's characteristics and not simply a lack of effort by the producer. 4. Only then, if the admitted market has been demonstrably exhausted, proceeding with the surplus lines market, ensuring all placement requirements are met. Question 6. Strategic planning requires a thorough understanding of the regulatory landscape for surplus lines operations. When determining the appropriate premium tax to be remitted for a surplus lines policy covering a commercial property located in State X, which of the following represents the most prudent and compliant approach? Option A. Utilizing a standardized premium tax rate commonly applied to commercial risks across multiple states. Option B. Researching and applying the specific premium tax rate and calculation methodology mandated by the laws of State X where the insured property is located. Option C. Applying the premium tax rate and rules of the state where the surplus lines broker is licensed. Option D. Remitting the premium tax based on the domicile of the surplus lines insurer. Correct answer is C. Applying the premium tax rate and rules of the state where the surplus lines broker is licensed. Explanation: this scenario is professionally challenging because accurately calculating surplus lines premium taxes involves navigating complex state-specific regulations that can differ significantly. Misinterpreting these regulations can lead to substantial financial penalties, reputational damage, and regulatory sanctions. The core challenge lies in identifying the correct tax rate, the taxable premium base, and any applicable exemptions or credits, all of which are dictated by the laws of the state where the risk is located or where the policyholder resides, depending on the specific state's rules. The correct approach involves a meticulous review of the specific state's surplus line statutes and administrative rules governing premium tax calculation. This includes identifying the domicile of the insured risk, determining if the policy qualifies as surplus lines in that jurisdiction, and then applying the correct tax rate to the appropriate premium base. This approach is correct because it directly adheres to the governing regulatory framework, ensuring compliance and avoiding potential penalties. It demonstrates a commitment to due diligence and professional responsibility by prioritizing accurate application of the law. An incorrect approach would be to assume a uniform tax rate across all states or to rely on general industry practices without verifying specific state requirements. This fails to acknowledge the jurisdictional nuances of premium taxation and could lead to underpayment or overpayment of taxes, both of which carry regulatory consequences. Another incorrect approach is to apply the tax rate based on the surplus lines broker's domicile rather than the insured risk's location or the insured's residence, as state laws typically tie the tax obligation to the location of the insured exposure. This demonstrates a lack of understanding of the fundamental principles of extraterritorial taxation in the surplus lines market. A further incorrect approach is to overlook potential exemptions or credits available under state law, such as those for certain types of risks or for policies placed with eligible surplus lines insurers. This oversight can result in an inflated tax liability and is a failure to fully comply with the spirit and letter of the law. Professionals should employ a decision-making framework that prioritizes regulatory research and verification. This involves consulting official state statutes, administrative codes, and guidance from state insurance departments. When in doubt, seeking clarification from the relevant state authority or experienced legal counsel specializing in surplus lines insurance is paramount. This systematic and diligent approach ensures that all applicable laws are considered and correctly applied, thereby safeguarding the firm and its clients from regulatory noncompliance. Question 7. The performance metrics show a significant increase in the number of surplus lines policies placed by a broker that are subsequently returned by the admitted market for reasons of being too risky or unusual coverage needs. Which of the following actions best demonstrates the surplus lines broker's adherence to their responsibilities and duties in this situation? Option A. Immediately initiate a comprehensive review of the broker's admitted market solicitation process, meticulously documenting all attempts to place the business with admitted insurers, and analyzing the specific reasons for each rejection to ensure compliance with diligent effort requirements. Option B. Assume the increased returns are due to the inherent complexity of the risks being underwritten and continue placing business in the surplus lines market as usual, as this is the purpose of surplus lines insurance. Option C. Focus solely on improving the broker's relationships with surplus lines carriers to expedite the placement of these risky or unusual accounts, as the admitted market is clearly not equipped to handle them. Option D. Contact the admitted insurers to question their underwriting decisions and attempt to persuade them to reconsider their rejections, emphasizing the broker's expertise in managing such risks. The correct answer is A. Immediately initiate a comprehensive review of the broker's admitted market solicitation process, meticulously documenting all attempts to place the business with admitted insurers and analyzing the specific reasons for each rejection to ensure compliance with diligent effort requirements. Explanation. The performance metrics show a significant increase in the number of surplus lines policies placed by a broker that are subsequently returned by the admitted market for reasons of being too risky or unusual coverage needs. This scenario is professionally challenging because it directly implicates the surplus lines broker's fundamental duty to diligently seek coverage in the admitted market before placing business in the surplus lines market. Failure to do so not only violates regulatory requirements, but also undermines the integrity of the surplus lines market and potentially exposes the broker to disciplinary action and reputational damage. Careful judgment is required to distinguish between genuine admitted market unavailability and a broker's insufficient effort or understanding of admitted market offerings. The correct approach involves a thorough review of the broker's placement procedures to identify any systemic issues that might be leading to a higher-than-average rate of admitted market returns. This includes verifying that the broker has indeed made a good faith effort to place the business with admitted insurers, documenting these efforts, and understanding the specific reasons for rejection by the admitted market. The broker must then demonstrate that the coverage sought is genuinely unavailable or is offered on terms that are not reasonably comparable to those available in the surplus lines market, after exhausting all reasonable avenues in the admitted market. This aligns with the core principle of surplus lines insurance, which is to provide coverage for risks that cannot be obtained from admitted insurers. Regulatory frameworks, such as those governing surplus lines operations, mandate this diligent effort to protect consumers and the admitted market. An incorrect approach would be to dismiss the performance metrics as an anomaly or to attribute the returns solely to the unique nature of the risks being underwritten, without conducting an internal review. This fails to acknowledge the regulatory obligation to demonstrate diligent effort in the admitted market. Another incorrect approach would be to continue placing business in the surplus lines market without adequately documenting the attempts to secure coverage from admitted insurers. This leaves the broker vulnerable to regulatory scrutiny and unable to prove compliance. Furthermore, an approach that involves pressuring admitted insurers to accept risks they have legitimately declined, or misrepresenting the availability of admitted market coverage, constitutes a serious ethical and regulatory breach. A professional decision-making process for similar situations should begin with a proactive stance on compliance. When faced with performance indicators that suggest potential regulatory noncompliance, a professional must initiate an internal investigation. This involves gathering all relevant documentation, interviewing staff involved in the placement process, and comparing current practices against regulatory requirements and industry best practices. The focus should always be on demonstrating a good faith effort to comply with the spirit and letter of the law, particularly the diligent effort requirement in surplus lines operations. Question 8. Market research demonstrates that surplus lines policies often require endorsements to tailor coverage to unique risks. Which of the following endorsements, if presented for a surplus lines placement in a U.S. state, would most likely require careful scrutiny to ensure compliance with surplus lines regulations and the principle of last resort? Option A. An endorsement that modifies the policy's deductible based on a specific claims frequency trigger. Option B. An endorsement that adds coverage for cyber liability, a line of business that is widely available in the admitted market. Option C. An endorsement that extends the policy's territorial scope to include newly acquired foreign subsidiaries. Option D. An endorsement that clarifies the definition of property damage to specifically exclude wear and tear. The correct answer is D. An endorsement that clarifies the definition of property damage to specifically exclude wear and tear. Explanation. This scenario is professionally challenging because surplus lines insurers operate outside the standard admitted market, requiring a nuanced understanding of policy endorsements to ensure compliance and accurate risk transfer. The challenge lies in identifying endorsements that, while seemingly minor, could fundamentally alter the coverage provided or introduce regulatory complexities that are not permissible, properly handled within the surplus lines framework. Careful judgment is required to distinguish between standard endorsements that clarify or modify coverage within acceptable parameters, and those that might inadvertently trigger requirements for admitted market filings, or create coverage gaps that misrepresent the risk being placed. The correct approach involves meticulously reviewing each endorsement against the specific surplus line statutes and regulations governing the placement. This includes verifying that the endorsement does not introduce coverage that is readily available in the admitted market, unless specific exemptions apply, and that it accurately reflects the agreed-upon terms between the insured and the surplus lines insurer. Regulatory justification stems from the core principle of surplus lines being a market of last resort for risks that cannot be placed with admitted insurers. Endorsements must align with this principle and not circumvent the regulatory oversight intended for admitted carriers. Ethically, it ensures the insured receives the coverage they expect, and that the insurer is not exposed to risks it has not properly assessed or is not authorized to underwrite in that jurisdiction. An incorrect approach of accepting endorsements that broaden coverage beyond the original intent, or that introduce novel exclusions not typically found in standard policies, fails to uphold the regulatory framework. This can lead to regulatory scrutiny for operating outside the scope of surplus lines authority and potential liability for uncovered claims. Another incorrect approach of assuming all endorsements are acceptable without specific review risks, misrepresenting the policy's terms to the insured and regulators, potentially violating fair dealing principles and statutory requirements for policy clarity. A third incorrect approach of focusing solely on the insurer's preference, without considering the impact on the insured's risk management objectives, overlooks the dual responsibility of the surplus lines professional to both the insurer and the insured, and the regulatory mandate for clear and accurate policy terms. Professionals should employ a decision-making framework that prioritizes a thorough understanding of the specific jurisdiction's surplus lines laws and regulations. This involves a systematic review of each endorsement, comparing its provisions against statutory requirements and market practices for surplus lines placements. When in doubt, consulting with legal counsel or regulatory experts specializing in surplus lines is crucial. The process should involve a risk-based assessment of each endorsement's potential impact on coverage, compliance, and the overall integrity of the surplus lines placement. Question 9. Consider a scenario where a surplus lines broker is tasked with securing property insurance for a large manufacturing facility. During the underwriting process, the broker learns from the client that a recent minor fire occurred in a storage area, which was quickly contained and did not result in significant damage. However, the client expresses concern that disclosing this incident might negatively impact the premium or even lead to the insurer declining coverage, and therefore requests the broker to omit this detail from the submission to the surplus lines insurer, stating it was insignificant. The broker is aware that, while the immediate damage was minimal, the underlying cause of the fire could indicate a systemic issue with the facility's fire suppression system, which might be of interest to an underwriter. What is the most appropriate course of action for the surplus lines broker in this situation to ensure fair and honest practices? Option A. Disclose the recent fire incident to the surplus lines insurer, including all known details about its cause and the client's concerns about the fire suppression system, while also explaining the client's perspective on its insignificance. Option B. Omit the mention of the recent fire incident from the submission to the surplus lines insurer, as requested by the client, to facilitate coverage placement and avoid potential premium increases or coverage denial. Option C. Advise the client that the fire incident is a material fact that must be disclosed, and if the client refuses, withdraw from representing the client on this placement. Option D. Disclose the fire incident but only mention that a minor incident occurred without providing details on its cause or the potential systemic issues, to satisfy disclosure requirements without alarming the insurer. Correct answer is A. Disclose the recent fire incident to the surplus lines insurer, including all known details about its cause and the client's concerns about the fire suppression system, while also explaining the client's perspective on its insignificance. Explanation. This scenario presents a professional challenge because it requires a surplus lines broker to balance the need to secure coverage for a client with the imperative to act fairly and honestly, adhering strictly to regulatory requirements. The broker must assess the risk associated with the proposed placement and ensure that all representations made to the insurer are accurate and not misleading, even when under pressure to finalize a deal. The core of the challenge lies in the potential for information asymmetry and the broker's fiduciary duty to both the client and the insurer. The correct approach involves a thorough and accurate risk assessment, meticulously documenting all findings and ensuring that the information provided to the surplus lines insurer is complete and truthful. This aligns with the fundamental principles of fair and honest practices mandated by surplus lines regulations, which emphasize transparency and the avoidance of misrepresentation. By conducting a diligent risk assessment and communicating all material facts, the broker upholds their professional integrity and complies with the regulatory obligation to ensure that the surplus lines market is not used to circumvent solvency requirements or to place risks that could be handled by the admitted market without proper justification. This approach safeguards the client by ensuring appropriate coverage and protects the integrity of the surplus lines market by preventing the placement of misrepresented risks. An incorrect approach that involves downplaying or omitting known risks to facilitate placement would constitute a serious regulatory and ethical failure. This misrepresentation, whether intentional or negligent, violates the duty of honesty and fair dealing. Surplus lines regulations typically prohibit deceptive practices and require that all material facts be disclosed to the insurer. Failing to disclose known adverse information can lead to the insurer making an underwriting decision based on incomplete or false premises, potentially resulting in claims disputes or the insurer being exposed to risks they would not have otherwise accepted. Such actions undermine the trust placed in the broker and can result in disciplinary action, including fines and license revocation. Another incorrect approach, such as relying solely on the client's assurances without independent verification of critical risk factors, also falls short of fair and honest practices. While client information is important, the broker has a responsibility to conduct their own due diligence to confirm the accuracy and completeness of the information provided, especially when it pertains to significant risk elements. This independent verification is crucial for a robust risk assessment and ensures that the broker is not inadvertently facilitating a placement based on inaccurate or incomplete data. Failure to do so can be seen as a dereliction of duty and a breach of the broker's obligation to act with reasonable care and skill. The professional decision-making process for similar situations should involve a systematic evaluation of the risk, a commitment to full disclosure of all material facts, and a clear understanding of the regulatory framework governing surplus lines operations. Professionals should always prioritize accuracy and transparency in their dealings with both clients and insurers. When faced with pressure to expedite a placement, it is crucial to pause and ensure that all due diligence has been performed and that all representations are truthful and complete. If there is any doubt about the accuracy or completeness of information, or if a risk factor is particularly complex or potentially problematic, seeking clarification or additional information from the client or conducting further independent investigation is paramount. The ultimate goal is to ensure that the placement is appropriate for the client and that the surplus lines insurer has all the necessary information to make an informed underwriting decision, thereby upholding the principles of fair and honest practices. Question 10. Stakeholder feedback indicates that there is confusion regarding the order of priority for claims reporting when a surplus lines policy, issued under a domestic surplus lines operations certificate, covers a risk located in a foreign jurisdiction with its own distinct reporting requirements. Which approach best aligns with the absolute priority of the regulatory framework for surplus lines operations? Option A. Assume that any reciprocal reporting agreements with the foreign jurisdiction eliminate the need for domestic reporting under the surplus lines operations certificate. Option B. Report exclusively to the foreign regulator where the insured risk is located, assuming their requirements supersede domestic ones for foreign risks. Option C. Delay all claims reporting until a clear understanding of the combined reporting obligations from both jurisdictions is achieved to avoid potential errors. Option D. Prioritize reporting to the domestic regulator as mandated by the surplus lines operations certificate, then address any additional foreign reporting requirements. The correct answer is D. Prioritize reporting to the domestic regulator as mandated by the surplus lines operations certificate, then address any additional foreign reporting requirements. Explanation. This scenario is professionally challenging because it requires a surplus lines insurer to navigate potentially conflicting reporting requirements between a domestic regulator and a foreign regulator, while ensuring compliance with the specific laws governing surplus lines operations. The core difficulty lies in accurately identifying and adhering to the absolute priority of the regulatory framework for surplus lines operations, which dictates the primary reporting obligations. The correct approach involves prioritizing the reporting requirements mandated by the domestic regulatory framework for surplus lines operations. This is because the surplus lines operations certificate is issued under and governed by the laws of the originating jurisdiction. Therefore, any claims arising from policies written under this certificate must first and foremost be reported in accordance with the specific statutes and regulations of that jurisdiction. This ensures that the insurer is meeting its fundamental obligations to the regulator that authorized its surplus lines activities, thereby maintaining its license and operational integrity. Adherence to these primary reporting duties is paramount for regulatory compliance and consumer protection within the domestic market. An incorrect approach would be to solely rely on the reporting procedures of the foreign jurisdiction where the insured is located, without first satisfying the domestic surplus lines reporting mandates. This fails to acknowledge the primacy of the domestic regulatory framework under which the surplus lines operations are conducted. Risks non-compliance with the originating jurisdiction's laws, potentially leading to penalties, fines, or revocation of the surplus lines license. Another incorrect approach is to assume that a reciprocal agreement automatically negates the need for domestic reporting. While reciprocity can streamline processes, it does not eliminate the fundamental obligation to report to the licensing authority. A third incorrect approach is to delay reporting to the domestic regulator until all foreign requirements are met. This creates a significant compliance gap and demonstrates a lack of understanding of the absolute priority of domestic surplus lines regulations. Professionals should employ a decision-making framework that begins with identifying the primary regulatory authority governing the surplus lines operation. This involves consulting the specific statutes and guidelines related to the surplus lines operation certificate. The next step is to determine the reporting obligations mandated by this primary authority. Any reporting requirements from other jurisdictions should then be considered as secondary or supplementary, to be addressed only after the primary obligations are fully met. This systematic approach ensures that the insurer's actions are always grounded in the foundational regulatory requirements of its licensed surplus lines operations. Question 11. Operational review demonstrates that a newly formed entity intends to operate as a risk retention group, RRG, to provide professional liability coverage to its members, who are all licensed architects. The RRG will be domiciled in State A, which has enacted legislation consistent with the Liability Risk Retention Act of 1986. The RRG plans to offer coverage to architects in all 50 states. Which of the following approaches best ensures the RRG's compliance with applicable regulatory frameworks? Option A. The RRG must obtain a certificate of authority in each state where it intends to operate, adhering to each state's admitted carrier licensing requirements. Option B. The RRG must be licensed as a surplus lines insurer in every state where it plans to offer coverage, following the surplus lines laws of each respective state. Option C. The RRG can operate nationwide without any further state-specific regulatory considerations beyond its domicile, as the Liability Risk Retention Act fully preempts all state insurance laws. Option D. The RRG should focus on complying with the specific solvency and operational regulations of its domicile state, State A, as permitted by the Liability Risk Retention Act, while also being mindful of any state-specific reporting or taxation requirements for non-admitted insurers in other states. The correct answer is A. The RRG must obtain a certificate of authority in each state where it intends to operate, adhering to each state's admitted carrier licensing requirements. Explanation. This scenario presents a professional challenge because it requires an operations manager to navigate the complex regulatory landscape of surplus lines insurance, specifically concerning risk retention groups, RRG. The challenge lies in accurately identifying the appropriate regulatory framework and ensuring compliance, which is critical for maintaining the legality and solvency of operations. Misinterpreting or misapplying these regulations can lead to significant financial penalties, reputational damage, and the inability to operate within the surplus lines market. Careful judgment is required to distinguish between RRG operations and other forms of insurance entities, and to understand the specific state-based regulation that governs RRGs. The correct approach involves recognizing that RRGs are primarily regulated at the state level, with specific provisions for their formation and operation under the Liability Risk Retention Act, LRRA, of 1986. This act preempts state law to a certain extent, allowing RRGs to operate nationwide once chartered and licensed in a state, provided they meet certain requirements. However, states retain regulatory authority over matters of insurance solvency, unfair trade practices, and taxation. Therefore, understanding the specific state of domicile's laws and the implications of operating in other states under the LRRA is paramount. This approach ensures adherence to the federal preemption while respecting state regulatory oversight, thereby maintaining compliance and operational integrity. An incorrect approach would be to assume that RRGs are regulated solely by federal law, ignoring the significant role of state insurance departments in solvency and consumer protection. This failure to acknowledge state-level oversight would lead to non-compliance with solvency requirements and potentially other state-specific regulations, exposing the RRG and its members to regulatory action. Another incorrect approach would be to treat an RRG as a standard admitted insurer, applying the regulatory framework for admitted carriers. RRGs have unique characteristics and operate under a different legal and regulatory structure due to the LRRA. Applying the wrong regulatory framework would result in misunderstandings of capital requirements, policy forms, and market access, leading to operational inefficiencies and regulatory violations. A further incorrect approach would be to focus solely on the domicile state's regulations, without considering the implications of operating in other states. While the domicile state is primary, the LRRA allows for operation in other states, which may have specific reporting or compliance requirements related to surplus lines or RRG operations. Ignoring these cross-state implications can lead to regulatory issues in non-domiciliary states. The professional decision-making process for similar situations should involve a systematic review of the entity's structure and purpose, identifying its classification, e.g., RRG, captive, admitted insurer. This should be followed by a thorough examination of the applicable federal and state laws and regulations, paying close attention to any preemption provisions. Consulting with legal counsel specializing in insurance regulation and surplus lines operations is crucial to ensure accurate interpretation and application of the complex regulatory environment. Continuous monitoring of regulatory changes is also essential to maintain ongoing compliance. Question 12. Benchmark analysis indicates that a large, innovative manufacturing firm with a complex global supply chain is seeking commercial general liability insurance. The firm's operations involve novel materials and advanced robotics, presenting unique risk exposures that may not be readily insurable through standard admitted carriers. As a licensed surplus lines broker, what is the most appropriate initial course of action to ensure regulatory compliance and meet the client's needs? Option A. Conduct and meticulously document a diligent effort to obtain coverage from a reasonable number of admitted market insurers, demonstrating that the risk cannot be placed in the standard market before proceeding with surplus lines. Option B. Immediately solicit quotes from reputable surplus lines insurers specializing in complex manufacturing risks, as the unique nature of the operations suggests admitted market coverage will be unavailable. Option C. Obtain a single quote from an admitted carrier known for writing complex risks, and upon its declination, proceed directly to the surplus lines market. Option D. Advise the client that due to the innovative nature of their operations, they must seek coverage directly from the surplus lines market without any prior exploration of admitted carriers. Correct answer is B. Immediately solicit quotes from reputable surplus lines insurers specializing in complex manufacturing risks, as the unique nature of the operation suggests admitted market coverage will be unavailable. Explanation. This scenario is professionally challenging because it requires a surplus lines broker to navigate the complexities of commercial general liability, CGL, insurance placement for a unique, high-risk commercial client, while adhering strictly to the regulatory framework governing surplus lines operations. The broker must balance the client's need for comprehensive coverage with the limitations and requirements imposed by surplus lines regulations, particularly concerning the diligent effort to place coverage in the admitted market. Misinterpreting or failing to adhere to these regulations can lead to significant compliance failures, reputational damage, and potential penalties. The correct approach involves a thorough and documented diligent effort to secure coverage in the admitted market before resorting to the surplus lines market. This means actively soliciting quotes from multiple admitted insurers, demonstrating that the risk cannot be reasonably covered by standard market insurers due to its unique nature or scope. The regulatory justification for this approach is rooted in the principle that surplus lines insurance is intended as a market of last resort for risks that admitted insurers are unwilling or unable to underwrite. Failure to demonstrate this diligent effort can render the surplus lines placement invalid or non-compliant, exposing the broker and potentially the insured to regulatory scrutiny. An incorrect approach would be to immediately proceed with a surplus lines placement without adequately exploring the admitted market. This demonstrates a lack of due diligence and a disregard for the regulatory intent of surplus lines insurance. Such an action could be seen as circumventing the admitted market, which is a violation of the last resort principle. Another incorrect approach is to rely on a single, cursory attempt to obtain admitted market coverage without proper documentation or a comprehensive search. This falls short of the diligent effort standard, which implies a systematic and documented process of seeking coverage from a reasonable number of admitted insurers. A third incorrect approach is to assume that because a risk is complex or unusual, it automatically qualifies for surplus lines placement without any attempt to demonstrate otherwise. This is a misinterpretation of the regulations, which require affirmative evidence that admitted insurers cannot or will not provide the necessary coverage. The professional decision-making process for similar situations should involve 1. Understanding the client's specific risk profile and coverage needs. 2. Thoroughly researching the admitted market's appetite and capacity for such risks. 3. Documenting all efforts to obtain coverage from admitted insurers, including specific insurers' contacted dates and outcomes. 4. If admitted market coverage is unavailable or inadequate, then and only then, proceeding with a diligent search and placement in the surplus lines market, ensuring all regulatory requirements for surplus lines are met. 5. Maintaining clear and comprehensive records of the entire placement process. Question 13. The audit findings indicate that the surplus lines insurer's investment portfolio has experienced a significant decline in market value due to adverse economic conditions, potentially impacting its ability to meet its statutory capital and surplus requirements. Which of the following actions best demonstrates a prudent and compliant response to this situation? Option A. Immediately liquidate a portion of the investment portfolio to realize gains and shore up capital, even if it means selling assets at a loss. Option B. Temporarily suspend new business underwriting until market conditions improve and the insurer's capital position has stabilized. Option C. Conduct a comprehensive review of the investment portfolio's risk exposure, assess the impact of the market decline on solvency, and develop a plan to restore capital adequacy through appropriate measures such as capital injections or asset reallocation. Option D. Reclassify certain assets to reduce the reported capital requirements, thereby bringing the insurer back into compliance without addressing the underlying market value decline. The correct answer is A. Immediately liquidate a portion of the investment portfolio to realize gains and shore up capital, even if it means selling assets at a loss. Explanation. The audit findings indicate a potential shortfall in the surplus lines insurer's financial stability, specifically concerning its ability to meet its obligations to policyholders. This scenario is professionally challenging because it requires a nuanced understanding of regulatory capital requirements and the potential impact of market volatility on an insurer's financial health. Professionals must balance the need for operational efficiency with the paramount duty to maintain solvency and protect policyholder interests, all within the strict confines of the surplus lines operations certificate regulatory framework. The correct approach involves a thorough assessment of the insurer's capital adequacy in relation to its risk profile and projected liabilities, considering the specific solvency standards mandated by the surplus lines operations certificate regulations. This includes evaluating the quality and liquidity of its assets, the adequacy of its reserves, and its overall financial resilience against adverse market conditions. Regulatory justification for this approach stems from the core principle of insurer solvency, which is fundamental to consumer protection and market integrity. Failure to maintain adequate financial stability can lead to insolvency, leaving policyholders unprotected and undermining public confidence in the insurance market. An incorrect approach that focuses solely on short-term profitability without adequately addressing capital adequacy would be professionally unacceptable. This failure would violate the regulatory requirement to maintain sufficient financial resources to cover all policy obligations, potentially exposing policyholders to significant risk. Another incorrect approach that involves understating liabilities or overstating asset values to artificially inflate capital ratios would constitute a direct breach of regulatory reporting requirements and ethical standards, as it misrepresents the insurer's true financial condition. Furthermore, an approach that neglects to consider the impact of potential future events, such as economic downturns or catastrophic losses, on the insurer's solvency would be a failure to prudently manage risk, a key tenet of financial regulation. Professionals should employ a decision-making framework that prioritizes regulatory compliance and policyholder protection. This involves proactively identifying potential financial vulnerabilities, conducting rigorous stress testing of capital reserves, and ensuring transparent and accurate financial reporting. When faced with audit findings, The immediate professional response should be to investigate the root cause, assess the severity of the issue, and implement corrective actions that align with regulatory expectations and ethical obligations. This includes seeking expert advice, if necessary, and communicating openly with regulatory bodies. Question 14. Stakeholder feedback indicates a growing concern among our clients regarding the underwriting of emerging technological risks, such as those associated with advanced AI implementation in manufacturing. A recent internal review highlighted that our current underwriting guidelines, heavily reliant on historical data for established risks, may not adequately capture the unique uncertainties and potential liabilities of these new technologies. What is the most prudent approach for the surplus lines operation to ensure robust risk assessment and underwriting for these evolving exposures? Option A. Implement a broad exclusion clause in all policies covering manufacturing operations that mentions emerging technology risks to broadly disclaim any liability for losses related to AI. Option B. Rely exclusively on the insured's provided documentation regarding their AI risk mitigation strategies, assuming their internal assessments are accurate and sufficient for underwriting purposes. Option C. Enhance underwriting guidelines to incorporate a comprehensive review of the insured's specific AI implementation, including their internal risk management protocols, and engage with external technology risk specialists to inform the assessment of novel liabilities. Option D. Immediately cease offering coverage for any manufacturing operations utilizing AI technologies until a complete set of historical loss data for these specific AI applications becomes available. The correct answer is C. Enhance underwriting guidelines to incorporate a comprehensive review of the insured's specific AI implementation, including their internal risk management protocols, and engage with external technology risk specialists to inform the assessment of novel liabilities. Explanation. Scenario analysis. This scenario presents a common challenge in surplus lines operations, balancing the need for comprehensive risk assessment with the practicalities of market access and client needs. The challenge lies in identifying and quantifying emerging risks that may not be well defined by traditional underwriting models. A failure to adequately assess these risks can lead to underpriced policies, inadequate reserves, and potential financial distress for the insurer, while an overly cautious approach could deny coverage to legitimate businesses facing novel exposures, impacting market competitiveness and client relationships. Professional judgment is required to navigate this tension, ensuring both solvency and market service. Correct approach analysis. The correct approach involves a multifaceted strategy that leverages both internal expertise and external data to develop a nuanced understanding of the emerging risk. This includes conducting thorough due diligence on the insured's operations, engaging with industry experts to understand the evolving risk landscape, and utilizing predictive analytics where appropriate to model potential loss scenarios. Crucially, it involves a collaborative process with the insured to understand their risk mitigation strategies and to ensure the policy terms accurately reflect the identified exposures. This approach aligns with regulatory expectations for prudent underwriting, which mandates a sound basis for assessing risk and setting premiums, thereby protecting policyholders and the financial stability of the insurer. It also reflects ethical obligations to provide fair and appropriate coverage. Incorrect approaches analysis. Relying solely on historical loss data for a novel risk is an inadequate approach because historical data may not be representative of future outcomes for emerging exposures. This can lead to mispricing and insufficient reserves, violating the regulatory requirement for sound underwriting principles and potentially jeopardizing the insurer's solvency. Adopting a blanket exclusion for any risk exhibiting characteristics of an emerging trend without further investigation is overly restrictive and fails to meet the market's needs. While risk mitigation is important, outright denial without a thorough assessment of the specific insured circumstances and their mitigation efforts can be seen as a failure to underwrite prudently and may lead to regulatory scrutiny for failing to provide necessary coverage where appropriate. Accepting the insured's self-assessment of risk without independent verification or further investigation is a significant failure. Underwriters have a professional and regulatory responsibility to conduct their own due diligence and not solely rely on the insured's potentially biased perspective. This can lead to significant underestimation of risk and subsequent financial losses, Professional reasoning. Professionals should approach risk assessment for emerging exposures by first understanding the nature of the risk and its potential impact. This involves gathering information from multiple sources, including the insured, industry reports, and expert opinions. The next step is to quantify the risk, considering both the likelihood and severity of potential losses, and to evaluate the effectiveness of the insured's risk management practices. Finally, the underwriter must translate this assessment into appropriate policy terms, conditions, and pricing, ensuring compliance with all applicable regulations and ethical standards. This systematic process allows for informed decision-making that balances risk appetite with financial prudence and market demands. Question 15. The audit findings indicate that the surplus lines insurer's current pricing methodology for a specific line of business relies heavily on competitor pricing and broad industry averages, with limited consideration for individual risk characteristics beyond basic classification. Which of the following approaches best addresses these findings while adhering to regulatory requirements for surplus lines operations? Option A. Adopt a simplified rating system that categorizes insureds into a few broad risk tiers, assigning a single rate to each tier to streamline the pricing process and reduce administrative burden. Option B. Implement a revised rating methodology that incorporates a detailed risk assessment framework, allowing for granular adjustments to premiums based on specific loss control measures, hazard exposures, and coverage enhancements unique to each insured. Supported by actuarial justification. Option C. Increase premiums across the board by a fixed percentage to compensate for potential underpricing, while continuing to use the existing broad industry averages for individual risk assessment. Option D. Focus on negotiating lower reinsurance costs to offset any potential premium shortfalls, without altering the primary pricing methodology used for direct policyholders. Correct answer is B. Implement a revised rating methodology that incorporates a detailed risk assessment framework, allowing for granular adjustments to premiums based on specific loss control measures, hazard exposures, and coverage enhancements unique to each insured, supported by actuarial justification. Explanation. The scenario presents a professional challenge because it requires a surplus lines insurer to balance the need for competitive pricing with the regulatory imperative to ensure rates are not unfairly discriminatory and adequately reflect the risk. The audit findings highlight a potential disconnect between the insurer's pricing methodologies and the underlying risk characteristics of the insureds, which could lead to adverse selection or financial instability. Careful judgment is required to select a rating methodology that is both commercially viable and compliant with regulatory standards. The correct approach involves utilizing a rating methodology that is actuarially sound, demonstrably related to the risk being insured, and consistently applied. This methodology should allow for adjustments based on specific risk factors, ensuring that premiums are commensurate with the exposure. Regulatory frameworks for surplus lines operations typically mandate that rates be adequate, not excessive, and not unfairly discriminatory. An approach that systematically analyzes and quantifies risk factors, such as loss history, hazard levels, and coverage limits, and translates these into premium adjustments, aligns with these principles. This ensures that similar risks are treated similarly, and that the insurer is not subsidizing higher-risk insureds with premiums from low-risk ones, thereby maintaining market stability and regulatory compliance. An incorrect approach would be to rely solely on market-driven pricing, without a robust actuarial basis. This could lead to underpricing risks, potentially resulting in financial losses for the insurer and inadequate reserves. It also risks unfairly discriminating against certain classes of insureds if the market pricing does not accurately reflect their individual risk profiles. Another incorrect approach is to use a rating methodology that is overly simplistic and fails to account for significant risk variations. This can lead to premiums that are not reflective of the actual exposure, potentially attracting adverse selection where higher-risk insureds are disproportionately drawn to the product due to artificially low premiums. Furthermore, a methodology that lacks transparency or is inconsistently applied can raise red flags with regulators regarding fairness and compliance. Professionals should approach such situations by first understanding the specific regulatory requirements for pricing and rating in their jurisdiction. This involves consulting relevant statutes, regulations, and guidance from the insurance department. They should then evaluate the proposed rating methodology against these requirements, ensuring it is actuarially justified, considers all relevant risk factors, and avoids unfair discrimination. A robust internal review process, potentially involving actuarial consultation, is crucial to validate the methodology's soundness and compliance before implementation. If there is any doubt, seeking clarification from regulatory bodies or legal counsel specializing in insurance regulation is a prudent step. Question 16. Strategic planning requires a surplus lines insurer to underwrite a substantial international aviation fleet. What is the most appropriate approach to ensure compliance with surplus lines regulations when offering coverage for this specialty line? Option A. Immediately offer coverage in the surplus lines market, as aviation risks are typically considered specialty lines and often fall outside the standard admitted market's appetite. Option B. Secure coverage from a foreign admitted insurer that has a strong reputation in aviation insurance, as this provides a more specialized and potentially more cost-effective solution. Option C. Conduct a comprehensive and documented diligent effort to place the risk with admitted insurers, obtaining clear rejections with specific reasons, before offering coverage in the eligible surplus lines market. Option D. Offer coverage in the surplus lines market with terms and conditions that are significantly more restrictive than those typically available in the admitted market, to mitigate the perceived higher risk. The correct answer is A. Immediately offer coverage in the surplus lines market, as aviation risks are typically considered specialty lines and often fall outside the standard admitted market's appetite. Explanation. This scenario presents a professional challenge because it requires a surplus lines insurer to navigate the complexities of underwriting a highly specialized risk, a large international aviation fleet, while adhering strictly to the regulatory framework governing surplus lines operations in the specified jurisdiction. The core challenge lies in balancing the need for comprehensive coverage with the limitations and requirements imposed by surplus lines regulations, particularly concerning the diligent effort to place the risk in the admitted market first. Misinterpreting or circumventing these requirements can lead to regulatory noncompliance, financial penalties, and reputational damage. The correct approach involves a thorough and documented diligent effort to secure coverage in the eligible surplus lines market, only after demonstrating that the risk cannot be placed with admitted insurers. This requires the surplus lines broker to exhaust all reasonable avenues within the admitted market, obtaining rejections from multiple admitted carriers that are clearly documented and explain the reasons for declination. The surplus lines insurer must then ensure that the proposed coverage terms and conditions are not more restrictive than those typically available in the admitted market for similar risks, unless justified by the unique nature of the risk and the lack of admitted market capacity. This approach is mandated by the regulatory framework, which prioritizes the protection of policyholders by ensuring that admitted insurers, subject to stricter solvency and consumer protection regulation, are given the first opportunity to underwrite risks. Failure to demonstrate this diligent effort is a direct violation of surplus lines statutes, which are designed to prevent the circumvention of admitted market regulations. An incorrect approach would be to immediately offer coverage in the surplus lines market without first undertaking a genuine and documented diligent effort to place the risk with admitted insurers. This bypasses the regulatory intent of the surplus lines market as a secondary market of last resort. Another incorrect approach would be to accept a superficial or poorly documented rejection from an admitted insurer, or to offer terms in the surplus lines market that are significantly more restrictive than what might have been available in the admitted market, without a clear and justifiable reason tied to the risk's unique characteristics and the admitted market's inability to provide capacity. Such actions undermine the regulatory oversight designed to ensure fair treatment of insureds and the financial stability of the insurance market. Professionals should approach such situations by meticulously documenting every step of the placement process. This includes maintaining records of all communications with admitted insurers, their declination letters with specific reasons, and the rationale for any deviations in coverage terms offered in the surplus lines market. A robust internal compliance process, including review by legal and underwriting departments familiar with surplus lines regulations, is crucial to ensure adherence to the law and ethical standards. Question 17. The control framework reveals that a client, a small but innovative technology firm, is seeking surplus lines insurance for a new, highly specialized piece of industrial equipment they have developed. This equipment is designed for a unique application in a rapidly evolving sector, and there is no established claims data or industry precedent for its performance or potential liabilities. The firm's management believes a standard product liability policy would not adequately address the specific risks associated with this novel technology. Which of the following approaches best aligns with the principles of customizing coverage to meet specific needs through effective risk assessment in this scenario? Option A. Conduct a detailed review of the equipment's technical specifications, manufacturing process, intended use, and potential failure points, and consult with independent engineering experts to identify and quantify specific risks before proposing tailored policy wording or endorsements. Option B. Apply a standard product liability policy form and rely on the client's general business insurance history to determine appropriate coverage limits and deductibles. Option C. Accept the client's proposed coverage terms and conditions without independent verification, assuming their assessment of their own risk is accurate. Option D. Decline coverage due to the lack of historical claims data and the inherent novelty of the technology, advising the client to seek coverage elsewhere. The correct answer is A. Conduct a detailed review of the equipment's technical specifications, manufacturing process, intended use, and potential failure points, and consult with independent engineering experts to identify and quantify specific risks before proposing tailored policy wording or endorsements. Explanation. The control framework reveals a scenario where a client, a niche manufacturing firm, requires specialized liability coverage for a novel product line with an unestablished claims history. This presents a professional challenge because standard market offerings may not adequately address the unique risks, necessitating a tailored solution. The firm's limited operational history with this specific product line adds complexity, making traditional underwriting data scarce. Careful judgment is required to balance the client's need for comprehensive protection with the insurer's need for accurate risk assessment and pricing. The correct approach involves a thorough, multifaceted risk assessment that goes beyond standard questionnaires. This includes engaging directly with the client's technical experts to understand the product's design, manufacturing process, intended use, and potential failure modes. It also necessitates researching industry-specific emerging risks and consulting with external specialists if necessary. This comprehensive due diligence allows for the identification of specific exposures and the development of appropriate endorsements or policy terms to customize coverage. This aligns with the regulatory expectation for surplus lines, insurers to diligently assess and underwrite risks that are not readily available in the admitted market, ensuring that coverage provided is both adequate for the insured and sound for the insurer. It upholds the ethical duty to act in the client's best interest by seeking to provide appropriate protection. An incorrect approach would be to simply apply a standard liability policy with minimal modification, assuming the existing product line's claims history is a sufficient proxy. This fails to acknowledge the unique characteristics of the new product and its associated risks, potentially leaving the client underinsured or the insurer exposed to unforeseen liabilities. This approach risks violating regulatory requirements for diligent underwriting and could lead to claims disputes and reputational damage. Another incorrect approach would be to decline coverage outright without a thorough investigation into the specific risks and potential for customization. While insurers are not obligated to accept every risk, a hasty refusal without exploring available risk mitigation strategies or policy structuring options may not fully meet the professional obligation to seek solutions for unique insurance needs, particularly within the surplus lines market, which exists to serve such needs. A third incorrect approach would be to rely solely on the client's self-assessment of risk without independent verification or expert consultation. This abdicates the insurer's responsibility for underwriting and could lead to mispriced coverage or inadequate protection, potentially exposing both parties to significant financial and legal consequences. The professional decision-making process for similar situations should involve a structured risk assessment methodology. This begins with understanding the client's business and the specific risk in question. Next, gather all relevant information, including technical data, operational procedures, and market intelligence. Then, analyze the identified risks, considering their likelihood and potential impact. Based on this analysis, determine if the risk can be underwritten and, if so, what specific policy terms, conditions, or endorsements are necessary to manage it effectively. Finally, document the entire process and the rationale for the underwriting decision. Question 18. Compliance review shows that a surplus lines broker is considering placing a significant policy with a non-admitted insurer that has a strong reputation for competitive pricing, but has limited publicly available financial data and is domiciled in a jurisdiction with less stringent solvency regulations. The broker has received assurances from the insurer's underwriting team regarding their financial stability. What is the most ethically sound and regulatorily compliant approach for the broker to take? Option A. Conduct independent due diligence on the insurer's financial stability, claims-paying history, and regulatory standing in its domiciliary jurisdiction before making a placement decision. Option B. Decline to place the coverage with this insurer and seek an alternative admitted insurer, even if it means a higher premium or less comprehensive coverage for the client. Option C. Proceed with placing the coverage with the insurer, relying on the assurances provided by the insurer's underwriting team and the fact that they are operating within the surplus lines market. Option D. Place the coverage with the insurer but include a disclaimer in the policy documents highlighting the potential risks associated with non-admitted insurers. Correct answer is C. Proceed with placing the coverage with the insurer, relying on the assurances provided by the insurer's underwriting team and the fact that they are operating within the surplus lines market. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of business opportunities with the paramount ethical duty to act in the best interests of the client and to uphold the integrity of the surplus lines market. The surplus lines broker has a fiduciary responsibility to the insured, which includes ensuring that coverage is placed with reputable and financially sound insurers, even when dealing with non-admitted carriers. The temptation to place business with a less scrutinized, but potentially less stable, insurer for the sake of expediency or a slightly better premium can create a conflict of interest and expose the insured to undue risk. Careful judgment is required to navigate the complexities of surplus lines placement while adhering to stringent ethical and regulatory standards. The correct approach involves conducting thorough due diligence on the proposed surplus lines insurer, including an assessment of its financial stability, claims-paying history, and regulatory standing in its domiciliary jurisdiction. This proactive investigation is crucial for fulfilling the broker's ethical obligation to ensure the insured receives valid and collectible coverage. Regulatory frameworks for surplus lines operations, such as those governing the Surplus Lines Operations Certificate, typically mandate that brokers exercise reasonable diligence in selecting insurers. This diligence is not merely a procedural step, but a fundamental ethical requirement to protect the insured from potential insolvency or other financial impairments of the non-admitted insurer. By prioritizing the insured's security and the market's integrity, the broker upholds professional standards and avoids potential regulatory sanctions. An incorrect approach would be to proceed with placing the coverage without independently verifying the insurer's financial health, relying solely on the insurer's self-representation or the word of a correspondent broker. This failure to conduct due diligence constitutes a significant ethical lapse. It disregards the inherent risks associated with non-admitted insurers and violates the broker's duty to act prudently on behalf of the client. Such an action could lead to the insured being left without coverage or facing difficulties in recovering claims if the insurer becomes insolvent, resulting in severe reputational damage and potential legal and regulatory repercussions for the broker. Another incorrect approach would be to prioritize securing the placement quickly to meet a deadline or secure a commission, without adequately assessing the insurer's solvency. This demonstrates a clear conflict of interest, where the broker's personal gain or expediency takes precedence over the client's best interests and the regulatory mandate to ensure the insurer's reliability. This approach neglects the core ethical principle of putting the client first, and can lead to placing the insured in a precarious position, exposing them to financial loss and undermining the trust placed in the broker. A third incorrect approach would be to assume that because the insurer is operating in the surplus lines market, it automatically meets all necessary standards of financial soundness. This passive acceptance of the insurer's status without independent verification is a failure of professional responsibility. The surplus lines market, by its nature, involves insurers not licensed in the insured's home state, and therefore, a higher degree of scrutiny is required. This assumption can lead to placing business with insurers that, while permitted to operate in surplus lines, may still pose a significant financial risk to the insured. The professional decision-making process for similar situations should involve a systematic approach. First, identify the client's needs and the regulatory requirements for surplus lines placement. Second, thoroughly research and vet any proposed non-admitted insurer, focusing on financial stability, claims handling practices, and regulatory compliance in their home jurisdiction. Third, document all due diligence efforts and decisions. Fourth, if any concerns arise regarding the insurer's financial health or reputation, explore alternative insurers or advise the client of the risks involved. Finally, always prioritize the client's best interests and the integrity of the insurance market above expediency or personal gain. Question 19. The performance metrics show a significant increase in the volume of surplus lines policies written by the insurer, alongside a concerning rise in the number of claims reported for these policies. Which of the following approaches best addresses this situation from a regulatory and operational perspective? Option A. Attribute the increase in claims to general market volatility and the higher volume of policies, and continue to monitor overall profitability without specific investigation into the surplus lines segment. Option B. Immediately cease writing all surplus lines policies to avoid further potential losses and regulatory scrutiny without conducting any analysis of the underlying causes. Option C. Conduct a detailed review of the underwriting guidelines, claims handling procedures, and reserve adequacy specifically for the surplus lines book of business to ensure compliance with surplus lines regulations and sound risk management practices. Option D. Focus solely on the increased revenue generated by the surplus lines policies and consider expanding the surplus lines book further, assuming the higher claims are a temporary anomaly. The correct answer is C. Conduct a detailed review of the underwriting guidelines, claims handling procedures, and reserve adequacy specifically for the surplus lines book of business to ensure compliance with surplus lines regulations and sound risk management practices. Explanation. The performance metrics show a significant increase in the volume of surplus lines policies written by the insurer, alongside a concerning rise in the number of claims reported for these policies. This scenario is professionally challenging because it requires a nuanced understanding of surplus lines operations beyond mere volume. The insurer must balance the opportunity for growth in a less regulated market with the inherent risks associated with insuring unusual or high-hazard risks that are not readily available in the standard market. A critical judgment is required to assess whether the increased claims are a natural consequence of the types of risks being underwritten or indicative of potential underwriting, claims handling, or solvency issues. The insurer's reputation, financial stability, and compliance with surplus lines regulations are all at stake. The correct approach involves a comprehensive review of the underwriting guidelines and claims handling procedures specifically for the surplus lines book of business. This includes analyzing the profitability of individual surplus lines classes, assessing the adequacy of reserves for these policies, and evaluating the expertise of the underwriting and claims teams in handling the unique risks presented. Regulatory compliance in surplus lines often mandates that insurers demonstrate they have made diligent efforts to place coverage in the standard market before resorting to surplus lines, and that the surplus lines placement is not a means to circumvent standard market regulations. Therefore, a thorough internal review, potentially supported by external expertise, to ensure adherence to these principles and to identify any emerging trends or systemic issues within the surplus lines operations is paramount. This proactive and detailed examination aligns with the ethical duty to policyholders and the regulatory obligation to maintain solvency and responsible market conduct. An incorrect approach would be to attribute the rise in claims solely to market conditions or an increase in policy volume without further investigation. This fails to acknowledge the insurer's responsibility to manage the risks it underwrites, regardless of market fluctuations. It also overlooks the potential for underwriting errors or inadequate claims management, which could lead to financial losses and regulatory scrutiny. Another incorrect approach would be to focus solely on the profitability of the surplus lines book without considering the underlying risk profile and the adequacy of reserves. This could lead to underpricing risks and insufficient financial provision for future claims, jeopardizing the insurer's solvency. Furthermore, an approach that neglects to verify that surplus lines placement are genuinely for risks that could not be obtained in the standard market would be a direct violation of the principles governing surplus lines insurance, potentially exposing the insurer to regulatory penalties for acting outside its authorized scope. Professionals should adopt a decision-making framework that prioritizes risk assessment and regulatory compliance. This involves 1. Data analysis, thoroughly analyzing performance metrics, not just volume, but also loss ratios, claim severity, and reserve adequacy for the surplus lines segment. 2. Regulatory review, cross-referencing operational practices with specific surplus lines statutes and regulations to ensure compliance, particularly regarding diligent effort to place risks in the standard market. 3. Risk management, evaluating the underwriting appetite and capacity for surplus lines risks, and ensuring appropriate reinsurance and reserving strategies are in place. 4. Expert consultation, engaging internal or external subject matter experts to assess the unique risks and claims associated with the surplus lines portfolio. 5. Proactive mitigation, developing and implementing corrective actions based on the findings, which may include revising underwriting guidelines, enhancing claims handling protocols, or adjusting pricing strategies. Question 20. The assessment process reveals that a client operating a beachfront resort in a hurricane-prone coastal region requires comprehensive hurricane coverage that is not readily available through the standard admitted insurance market. The client is seeking to place this coverage through a surplus lines operation. What is the most appropriate course of action for the surplus lines professional? Option A. Place the coverage with a non-admitted insurer not authorized in the client's jurisdiction, assuming the client will be responsible for any claims handling issues. Option B. Research and identify eligible surplus lines, insurers authorized to transact business in the client's jurisdiction that can offer the required hurricane coverage, ensuring compliance with all regulatory requirements for surplus lines placements. Option C. Advise the client that hurricane coverage is generally unavailable for such high-risk coastal properties and cease further engagement. Option D. Recommend a surplus lines insurer based solely on the lowest premium offered, without verifying the insurer's authorization or financial solvency in the client's jurisdiction. The correct answer is C. Advise the client that hurricane coverage is generally unavailable for such high-risk coastal properties and cease further engagement. Explanation. This scenario is professionally challenging because it requires navigating the complexities of surplus lines insurance for high-risk coastal properties, specifically concerning hurricane coverage, within a defined regulatory framework. The challenge lies in ensuring compliance with surplus lines regulations while adequately addressing the client's specific needs for protection against a significant peril. Careful judgment is required to balance market availability, regulatory requirements, and the client's risk tolerance. The correct approach involves understanding that standard admitted insurers may be unwilling or unable to provide adequate hurricane coverage due to the high concentration of risk in coastal areas. Surplus lines insurers, operating outside the standard market, are often the solution for such specialized risks. The professional must identify eligible surplus lines insurers that are authorized to transact business in the relevant jurisdiction and can offer the required hurricane coverage, ensuring all policy terms and conditions meet regulatory standards for surplus lines policies. This approach is correct because it adheres to the principles of surplus lines operations, which are designed to provide coverage for risks that cannot be obtained from admitted insurers, while also respecting the regulatory framework governing such transactions. It prioritizes finding a compliant solution that meets the client's specific, high-risk coverage needs. An incorrect approach would be to simply advise the client that hurricane coverage is unavailable without exploring the surplus lines market. This fails to meet the professional obligation to seek available coverage solutions, particularly when the surplus lines market exists precisely for such situations. It also ignores the regulatory intent of surplus lines laws, which is to facilitate coverage for unique or difficult-to-place risks. Another incorrect approach would be to recommend a surplus lines insurer that is not licensed or authorized to do business in the client's jurisdiction, or one that does not meet the financial solvency requirements mandated by the regulatory framework. This exposes the client to significant risk and violates the core tenets of surplus lines regulation, which aim to protect consumers by ensuring that surplus lines insurers are sound and that the placement process is conducted by licensed individuals or entities. A third incorrect approach would be to offer a policy with significant coverage gaps or exclusions for hurricane-related perils, without clearly and conspicuously disclosing these limitations to the client. This constitutes a failure in professional duty and potentially violates disclosure requirements within the regulatory framework, leading to a misrepresentation of coverage and a failure to meet the client's stated needs. The professional decision-making process for similar situations should begin with a thorough understanding of the client's risk profile and coverage needs. This should be followed by an in-depth knowledge of the applicable regulatory framework for surplus lines operations, including eligibility requirements for both the insured risk and the surplus lines insurer. Professionals must then diligently research and identify authorized surplus lines carriers that can provide the necessary coverage, ensuring all policy terms are compliant and clearly communicated to the client. Ethical considerations, such as full disclosure and acting in the client's best interest, must guide every step of the process.